it's if I would have been speaking to you a few weeks back, the narrative would have been buy on dips, but it's very, very quickly changed to the sell on rise. And I think that's how the market's viewing today's rally as well, or the kind of, whatever you want to call it, a relief rally from the 6 days of downward markets. I suspect that would not. It's probably going to be one of those days where you get some relief. But holding those positions over a weekend, given what's happening in the Middle East and around Israel and Gaza, I suspect probably not. So might be some relief today, but I don't think you'll be wanting to hold those positions over the weekend, given the situation in Gaza.
Sure. Andrew, I'd want to understand from you, putting things in perspective and probably connecting the dots here, US Treasury yields, which are around that 5% mark, also make for a case for a weaker set of, sentiment for equities. Combined with that, you're seeing the geopolitical concerns, soft earnings. You think all of that has been factored into the markets? You think Nifty can scale back to that level of 22,000 mark perhaps in this year? What are your targets there?
Yeah, so you're correct. It's been more global than local factors up until recently, and obviously even when the problems with Israel came to the forefront, it didn't really spike the oil prices up. It didn't really move markets globally, but the bond yield at 5% did. And that took the risk off trade globally, including emerging markets, off, and that really kind of led to FII selling. But in between time, what we've had locally is that you've had the results season start. Now, it's not a disaster, don't get me wrong, but the IT sector, really didn't deliver or delivered the poor results that we all expected. But again, the commentary thereafter was again very weak in terms of the outlook. But more surprisingly for the banks, again, results kind of broadly in line. The whole discussion around, net interest margins or NIMs has been, is it a one-off? Are we going to continue to see this weakness? I think most people are thinking it's going to be one quarter. But the banks didn't give us any confidence that that's the case. So, there could be, that's the reason why I think that the banking sector is under pressure, because even though you're seeing, good economic growth, good loan growth, the NIMs are under pressure as everyone races to get deposits into the bank. So I think those two factors locally haven't helped our markets either.
So what's really working for you in this market? What are the levels that you're looking at? Is your the target of Nifty 20,000? When do you expect that to perhaps hit the mark by the end of the year, or you think it's going to be longer than that? And if yes, what are going to be the factors essentially which could drive the growth here on, barring liquidity, which seems to be the only factor working in the favor of the markets?
Yeah, so we have a target, or our kind of target, Nifty target is 20,000 by March 2024, and that was predicated on a couple of things, Nikki. One was that the earnings growth should start to pick up from the second half of the year. That's i.e. from September just gone all the way through to kind of March, April of next year, as the capex by the government and private sector has that multiplier effect on the economy. So I expect earnings to start to improve as we go into 2024. So that's one part of the reason for the move for the index. Second, obviously, we'd be thinking about elections at that point, and I'm sure there'll be some positive vibes around that. And thirdly, I do expect interest rates to fall globally. Now, I've been saying by the end of the year, it's looking a bit edgy at the moment, but maybe the first quarter, that narrative will change to interest rates falling as the global economy starts to reel under the pressure of 5% yields in the US in particular. So that will give the momentum to the market. So that's our target as of now.
Point well taken. I'd also want to understand, you said perhaps the driver of the growth here on would be the earning growth which will come through. So clearly there's been disappointment there, like you mentioned, banking, IT, and also FMCG, so to speak, with Colgate also delivering a flat volume growth. With that in perspective, where do you think, which are the areas of strength or the pockets of strength which will perhaps lead to this earning growth?
I think it's going to be, partly from the government spending, which has, again, that multiplier effect in terms of, when you build bridges, roads, and, you'll get new kind of construction around that in terms of housing, and therefore that has that multiplier effect across different industries. And I think we'll start to see that play out in the second half. But, I think you've got to look at the themes below the index, Nikki, and it's something we talked to you about before in that, defense, renewable energy, for example, are areas where, spending is going to continue, no matter, what we're thinking, both globally and locally, particularly given what's happened with Israel recently. So those are two sectors, are going to have a lot of capital commitments and a lot of growth going forward. And then you can look at other themes like consumption, maybe slightly different than FMCG, but look at your kind of hotels, your airlines, where people want more experiences these days, not just the travel part of it, and premiumization in the beverage industry, both alcoholic and non-alcoholic, which again is at the very start of the runway in terms of the growth that we're going to see over the next 3 to 5 years. So these are some of the themes I think you can play out and make good money out without just looking at the index.
Okay, but I'm just going to step back and take a little more, or expect a little more aerial view from you in that case. Over the last 1 month, BSE midcap 1-year valuation has corrected from 28.86 to 27 times. Small cap valuation too has come down from 24 times to around that 23.5. So there is a bit of correction which has been witnessed in the midcap and the small cap valuation. You think with the correction that is set in for the broader counterparts, the correction is overdone, or you think there is more to come in, and perhaps now investors need to start reassessing their options of larger counterparts? Look at it closely. What's your assessment?
So it's a great question, and I think that's going to be the debate over the next quarter, isn't it? You got the main index, the Nifty trading at 17 times PE, which is not overly expensive compared to history. So I think if you're going to see a rally, it's going to be led by large caps. I think mid caps and small caps, I think now you'll start to see that differentiation in terms of the stock picking part of that, rather than being tarred with the same brush on the way up and on the way down. So I think, for those quality companies in each of those kind of segments, I think you'll start to see the outperformance, and some of those companies or sectors which were just over kind of buoyed with optimism, I think will now struggle for some time, and we'll start to see that derate and the quality, kind of themes and companies start to outperform. So I think it's going to be, if at best for small and mid caps, I think we're going to see, a fall of, maybe another 4 or 5% from here.
Okay, and for the larger counterparts, what gives you the confidence that perhaps they could be the next growth drivers for the markets, if at all? Because, the stock returns haven't really reflected their earning growth profile thus far over the last 30 months or so to say. What gives you that kind of confidence?
I'd say it's the confidence of the fact that, you will see earnings upgrades, and that will be more from the large cap companies going forward. So I think that's where I'm getting the confidence, and that's why, whilst it's not a big target to get in terms of Nifty at 20,000 by March, April of next year, you will see pockets of the Nifty, and I think that will be led by the banking sector going forward, which will be the one which will surprise on the upside.
Right, let's talk about FII data. There have been sellers thus far, and the number is rather huge that we've seen in today's session too. But if you take a step back, perhaps for the last 2-3 years, we've seen FIIs been on the selling side, and perhaps DIIs being structurally invested into the India's growth story, with SIPs also doing pretty decently. Do you think this trend is expected to continue here on? Do you think if there was any kind of change or further escalation of geopolitical concerns that can lead to further amount of erosion coming in, or let's just say withdrawal of money coming in from FII, which will perhaps now look at China more as compared to India?
So Well, I think, let's take the first part of it, which is obviously if there's an escalation of what's happening in the Middle East, then the risk off trade comes very quickly, and foreign investors will, in terms of taking money off the table, will do it across all markets, but they might do it more in India because you have a more highly rated index in terms of valuations compared to other emerging markets, and you have still some pretty strong gains compared to other markets too. So that's where you initially take money off. I think in terms of this whole debate whether India will get more money from FIIs because of the woes in China, I think is slowly turning around. I mean, whilst I'm still of the view that China's been taking a pea shooter or a water pistol, whatever you want to call it, to kind of shore up the economy and confidence. The whole ream of kind of proposals that they've done are starting to work positively at the edges. Now, if they came with a big bazooka and fired that, where you get consumer confidence that the property market is going to start to stabilize, if not improve, that's where I think foreign investors will look back at China and say, okay, things are changing for the better, the valuations are a lot lower, and therefore incrementally I'll be putting money towards China. Not saying against India, but more towards overweighting China in the shorter term compared to India.
Andrew, one last question that I have for you. I'd want to understand, a lot of bearish sentiment has clearly crept in the last 7 trading sessions with the amount of correction that has come through, and perhaps a bit of confidence seems to have taken a little bit of hit. What's your recommendation to the viewers out there, things that they're not ought to do in a market like this?
I think what not to do is to kind of panic too much. If you pick the right companies and you believe in them longer term, this is always a great opportunity to buy into them again. Buy more. I mean, just think about it as an investor. You've got your SIPs, so you're buying at the top, you're buying at the middle, and you're buying at the bottom. If you're doing it with stocks, and that's the kind of the way I would go about it. So not to panic and not to kind of rush out, kind of get out of your clear companies where you believe that there's a great growth path with good management. I would continue just to kind of buy into that rather than sell out in because of the market kind of volatility that we're going to see in the very short term.